All right, what's up, everyone? I am excited to interview Mitch Kider. I can't remember exactly how many times Mitch and I have created content together, but he is truly the leader when it comes to compliance. No one has given more to this industry than Mitch when it comes to not only helping lenders be compliant, but helping them do it in a way that better serves families. Mitch, I noticed when we were at the IMB this year, I don't know if you do this every MBA event, but you've got a room off to the side that's pretty easy to find. And it looks like you just have back-to-back 30-minute meetings with executives, bringing value to every event outside the event. How often do you do that?
I do that at every event. I do it at every MBA event. I get a room for 2 days, and I just pack it in with clients, some people that aren't clients, and we're just talking about the industry, what's going on, what they need to know, and where we go from there.
How many meetings do you think you get over a day or 2 day? How many different executives?
So over the 2 days of the IMB meeting, I did 33 meetings.
So, guys, think about that. Like, this is a man who, truly no one has represented more lenders and more cases, been more responsible for clients and legislation, this guy. And he's still, spending 2 days on his own budget to bring value. So, anyways, I applaud you.
Thank you.
And I love the way you always start it, like, hey, how's it going? What are the top issues? You always show up with a lot of curiosity.
Yeah, yeah. Well, it's a great industry. It's got great people in it, and I have been blessed with the ability to help them over all these years.
Yeah, well, I love this industry as well. Thank you for also being on the board of directors of First Home IQ, and all the value. At the very end of this interview today, guys, there's a 2 minute, kind of like a little mini movie on Mitch Kider's home ownership story and how he got into home ownership and part of his passion for the industry. So at the very, very end, we'll have that added. So check it out. So Mitch, we've got a lot of loan officers on this call. We will have a lot of C-suite executives on this call. So if there were, I don't know, two or three legal trends, regulatory issues that everybody should be thinking about right now in 2026 and over the next couple of years, what would be those top two or three issues?
So there are a number of things that you should be thinking about. Let me start off with what compliance really is and how you should think in terms of compliance. With the CFPB effectively from an enforcement perspective being shut down, okay? A lot of lenders, a lot of companies are, debating what they do about that. And there's discussion about what others are doing down the block and they're not being compliant and things along those particular lines. Well, first, I would say that for the next couple of years, you should not forget that when we talk about compliance, we're talking about compliance with laws. That's what we're referring to. And that's important to remember because it's not a game of, well, do I have to comply with this piece of federal legislation or anything else along those lines? As long as those laws remain on the books, the answer is you have to. You have to do that. And there are certain things in certain areas that I see an uptick in, for example. Okay, the FTC, the Federal Trade Commission, which was always meant to be our nation's consumer protection agency, okay, they're looking at your advertising. They're looking at your advertisements, they're looking at your marketing, and they're taking action. The FTC is an active group. This is not just for mortgage bankers, but in general, those guys are taking about 10 actions a month, right? Across the board, across industries. They're pretty active. And so, one of the things that we're seeing a lot of today is a review of your marketing and your advertising and really what it is you're telling consumers. Now, the FTC, for example, has its own UDAP, unlike the CFPBs, which they have authority over as well. But they have their own UDAP and they've had it for a lot of years. So one thing that I would say is, don't just look at these laws and say, okay, no one's complying and it doesn't look like there's anything going on because there's a lot going on. Okay. And the trend that goes along with that as well is that states are really stepping it up. The states, the CF, the C, the states have, hired people that have come out of the CFPB. The CSBS has hired some people that have come out of the CFPB that were senior executive officers of the CFPB, like David Blaken, who happens to be a very, very good guy. Okay. And they're building their enforcement mechanisms as well. And there's a lot going on with states in terms of state examinations. So I would say that. The other thing that I would say when I tell you, just remember that what we're talking about is compliance with laws and not the fact that this administration doesn't want the CFPB to be enacting or implementing enforcement actions itself, is that as long as these laws remain on the books, and some of them may not, but as long as these laws remain on the books, okay, you have private litigants that are chasing companies, chasing individuals under these laws as well, especially when it comes to RESPA. I mean, you see some of the litigation that's out there. You see the litigation against Rocket. You see the litigation against Zillow. You see other litigation that's going on under the Real Estate Settlement Procedures Act. So that's all there. In terms of what are the biggest areas that I would be concerned about for this year and going out to the future, you've got to put cybersecurity on the top of your list. Okay, that actually is the issue of our time. That's what it is. And that is a cat and mouse game, and it always will be. We'll always have to worry about cybersecurity. And you've got to put it on the top of your list. And it's expensive to get it right. It's expensive to get the safeguards in place. It's expensive to review it, but it's absolutely essential because a cyber breach can wipe out a company, in all honesty. And it has wiped out companies in the past. And your state regulators are really active. Whenever there is a cyber breach of a mortgage lender, they're very active in chasing after that mortgage lender after the fact. Okay. Some states, I had someone in the state of California that actually said to me, ipso facto, if there was a breach, you must have violated one of our laws concerning cybersecurity. It's just an unbelievable attitude. So I put that one on the top of your list, Dave. Absolutely. I put cybersecurity there. I put marketing and advertising because states are out there to protect their consumers. That's how they view it, okay? Especially state AGs, right? And so they're going to look at whether or not you're being deceptive in what you're telling the consumer. And they're looking at it now. And the last thing that I put out there, which is going to shake out over the next couple of years, and you need to be vigilant about it, is fees, costs and fees and how they're disclosed. Because that's a big issue and seems to be an issue that's somewhat bipartisan. The last administration at the CFPB really, if they could wipe out all lender related fees, they would have wiped out all lender related fees. Even if you look at this administration, if you look at the Trump administration, especially now in an election year, they're concerned about mortgage fees as well. And they've expressed that concern about mortgage fees. So those are three areas that I would cyber, advertising and marketing and fees that you're going to see a lot in the news in the coming years to come.
So, I mean, you're very familiar with what we do at Mortgage Coach and how we help lenders display rates and fees in a way that goes beyond just typical disclosures, like I call it uncommon transparency, like show people the cost over the time that they're likely to have the loan.
Yeah.
What how do you look at the importance of that? Because over the many years you and I have been doing stuff like this, you were always talking about, hey, the consistency of how you're delivering rates and fees, especially when it comes to pricing concessions. How has that changed, and in what's happening that you think has impact on the whole advice with price movement?
So I think what's happening, starts with a fundamental issue. And that is most consumers don't understand how the mortgage banking industry works or how mortgage lending works itself. So, and I'm sure loan officers can relate to this. A lot of times when you get you get a new prospect, especially if they're a first-time home buyer. Okay, they're almost like a deer in the headlights. They don't understand everything that you're saying. They don't understand everything that you're doing, and they certainly don't understand the federal disclosures that somehow became law. I mean, that's just the reality of it. So I actually think what you're doing with Mortgage Coach and what you're doing up front is really important because the consumer needs to, get this in real time before they ultimately make that decision and in a manner that's really understandable. And that's critical. That's critical.
All right, everyone. It's never been more important to make sure that you're quoting rates accurately and to make sure you're showing the long-term benefits over those different loans. And it's never been easier to do that. So check out our newest capability at Mortgage Coach, where literally you can use an AI prompt like this one right here, and in a matter of seconds, you could create a total cost analysis. So AI is looking at all the data. It has the email. So if we have data on that particular client, we can update the prompt. So as a loan officer, you could voice to text this prompt. Notice that it created a strategy, a mortgage strategy it's putting together. And now it's making it so you can visualize that. Uh, you can click create presentation, and literally in less than a minute, 30-ish seconds, you can create a mortgage coach, total cost analysis, mortgage coach presentation for consumers that also has AI built into it. So they can ask questions like, what is APR? Not exactly the question local loan officers want to be asking, but could also be questions like, if I'm going to live in the home for 5 years, which option is better? So like simple what if questions. And here's the beauty. Customer AI, you know exactly what they asked. You're getting a transcript of that. And loan officer AI, you're using the AI prompt to actually create something faster and easier. So let's get back to Mitch, but I wanted to make sure everybody saw that. If you want to learn more, go to trustengine.com or mortgagecoach.com.
And that's what regulators are starting to look at now, in all honesty. To the extent there remains, a fair amount of regulation and regulatory enforcement out there, it actually deals with that particular issue. Does a consumer understand, or are you pulling the wool over their eyes? And doing something up, something else. Because to a lot of consumers, it's smoke and mirrors. They don't. So it's important. And I think more and more, it's going to become more and more important. And maybe even in time, not in the next 3 years, maybe, but maybe thereafter, these types of systems may even become mandated, in all honesty, because it's needed, it's necessary. And so, yes, and you talked about consistency, of course. You've got to be consistent across the board, right?
Yeah. So just a reminder to everyone, so often you can implement something that improves compliance that also improves profitability and top line production. This is just one of many, call it touch points, where you're delivering something to the consumer that if you do it right, you improve compliance, you improve profits because you have less concessions and you have less, credit reports that go to waste, which is obviously another issue. What is there anything new or anything that folks should just be paying special attention to as it pertains to pricing concessions?
Well, pricing concessions have been somewhat problematic in the past because of our fair lending laws. And the CFPB was very, very active in past administrations when it came to pricing concessions. Because the reality is, if you looked at it statistically, and this is true statistically, we can all sit here and say, we're all colorblind and no one's doing these things intentionally. But if you look at it statistically in the past, okay, the beneficiaries of a discretionary pricing policy have been not minorities that are protected under the Fair Housing Act, okay, but have been white men under the age of 62, probably the only unprotected group that exists, right? They have been the beneficiaries of better pricing. And despite the fact that you're not reading about or seeing things today about fair lending on a federal level, okay, you are seeing it on a state level. And so you still have to be very, very careful about pricing, and the amount of discretion that's laid out there for pricing purposes. Now, it's important to mortgage bankers, and it's important to the consumer to be able to have some discretion. In all honesty, you want to make the deal work. You want to make it affordable. You want that consumer to be able, you want them to stay with you, and you want them to be able to buy that house or refinance or do something else along those lines. But you should always look at it from a fairness perspective. Always look at it from a fairness perspective.
So what about AI? I mean, we're starting to see lenders using AI in many ways, ranging from like we've integrated AI into the customer experience so that a consumer can ask our total cost analysis questions and get an AI enabled experience. And then some of the most aggressive things is you're seeing AI voice calling calling past customer databases, uh, mainly from a retention perspective. They're getting data signals and then they're giving a call. What what should lenders be careful of when it comes to that? And are you seeing a lot of that on your side? I know I'm seeing a lot of it.
So the answer is yes, I see a lot of it. I represent a number of AI companies in this market, in this business, including some of the ones that are, starting to be more prevalent in the industry itself. So I see a lot of it. I love AI. I think it's a fantastic tool. I think it's extraordinarily helpful, and I think it's going to change this business dramatically, in all honesty. I also think that AI, to a large extent, is the industry's answer to the margin crunch that it's been suffering through for so many years now, and
Agree.
make you so much more efficient. So there are a lot of things you need to think about. You mentioned voice AI. Voice AI is great. If you've ever listened in on any of those phone calls, it's just amazing what they can do. But it's important that you follow our laws as they approach, as they apply to voice AI as well. So, back in 2024, the FCC, Federal Communications Commission, right? They determined that voice activated AI, or what voice AI, uh, you know, constitutes an artificial voice for purposes of the TCPA. Okay. So you can't just call people up. You have to make sure they're not on a list. You have to make sure that you do it during proper time and proper hours, and that you otherwise have approval to do that. Utilizing voice AI is, requires you to do certain things, in my opinion. Number one, you need to get consent, right? And that consent should be in writing, and you should get that consent early on in your transaction. So that's number one. And I say it should be written consent. I will tell you that this past February, the Sixth Circuit Court of Appeals, said, well, the statute doesn't talk about written consent and it doesn't distinguish between consent for marketing purposes or consent for informational purposes. And so they said you only need to get prior express consent. But I will tell you, though, that's one circuit, and that issue will be revisited. But beyond that, the best practice is to get that written consent, because otherwise you're going to run into trouble. You're going to run into challenges. You have to be concerned about disclosure. Okay, if I pick up that telephone, do I know that I'm talking to a uh, a voice AI, a virtual assistant, or do I think I'm just talking to a person? And if I think I'm just talking to a person, you're going to have a problem on your hands as well. So this should be disclosure right up front. Not only that, you need, so that you satisfy our states who hold your licenses for the most part, especially if you're an IMB and and a licensed loan officer working for an IMB, you need a loan officer behind that. So what you ought to have right up front is a disclosure that it's a virtual assistant, okay? That in fact, if at any point they want to talk to a loan officer, here's the name, of that loan officer, and we can put them over to that loan officer, or they can call that particular loan officer. You need the company name, the NMLS number, and everything else that goes along with it. All right? Because states are going to require that. Okay? And then you get into, the real nitty-gritty of things. You better have sufficient safeguards under Graham Leach Bliley. You have to worry about data protection and data privacy, right? And what server is ultimately being used, and do you have that same type of protection that you've otherwise got internally along those particular lines? Things that go to that. So there's a lot to think about with voice AI, but it's great. And what I'm seeing out there in the industry is fantastic. And yes, I've been working with voice, with all types of AI companies, including those that are providing this voice virtual assistant on those issues.
Yeah, no, I'm with you. I definitely think it can improve margins, can reduce costs. I always love technology when it creates more value for the consumer. And so when you can consistently call at the right time, it has the most value for the consumer. You can have a message that's useful to the consumer. And then one of the things we're doing with these folks is we're using AI prompts to actually create the mortgage coach so that literally you've got the data. So you kind of know what the tangible benefits are for the consumer.
Yeah.
And then you can also take from the transcript and enhance that message. At the end of the day, you can help consumers know the right decision to make at the right time. So I'm a big fan. Now, this brings up a point with human in the loop, like humans in the loop in our process. I think I asked you this question when I saw you at the IMB, but do you think there will be a time when a human being's out of the loop and you could close a loan without a licensed human loan officer who's responsible for it? And I remember your answer, but I would love to get it for the whole industry. Like, what are your thoughts on if that will happen and when that will happen?
I actually don't think that will happen. I think there will always be a human in the loop. Okay, the role may be different. In some cases, may be diminished. In some cases, may be increased. Okay, it's more of a supervisory role. It's more of a knowledge role in understanding what's going on with that transaction, being able to step in, and it's a responsibility role. I do not believe that state regulators will allow you to originate these loans without a human ever being in the loop, because you don't license a virtual assistant. You license an individual. That's who your loan officer is. And it's your licensee that ultimately has to be responsible for what's going on in that transaction.
So they would be basically legislating themselves out of jobs, like if they did it.
They would. They would. But I think yeah, I think that's right. But I think there are some legitimate concerns out there about not having an individual in the loop in its entirety. So what that means is what role you have to play in that loop, how many loans will be under your review and supervision that's going through your virtual assistant. That all still has to be determined. But there's got to be a loan officer there, and the consumer has to be able to talk to that particular loan officer. And I don't think that's going to change.
Good, good. Uh, for all the local loan officers, good news, but that does mean you need to get great at using AI, using technology to just be more effective for consumers, do more loans, create more value. So another trend we're seeing, fully digital home shopping platforms that are both the real estate side, the lending side.
Mhm.
We've now got, Housing Wire puts on the gathering every year. I love it because we have both mortgage and real estate under the same roof from a leadership perspective. But I am curious, is this going to change the definition of steering, and what are your just thoughts on, these models and the do's and don'ts and how it look, what they should be doing now and what they should be thinking about in the future.
So I think it's important that the industries get more fully integrated in the manner in which they're doing it. And I actually, I spoke at Housing Wires Gathering the last time around, and I think they do a great job putting together a mortgage with real estate. I think that's wonderful. But the steering issue really is a referral issue. That's really what we're talking about. And when we talk about that, we're talking about Section 8 of RESPA. No one can make a referral, okay, in exchange for anything of value. No one shall give, no one shall accept anything of value in exchange for, you know, referring business incident to a settlement service. That's really what we're talking about. And usually, if you're looking at it from a realtor lender perspective, you're usually looking at a realtor making a referral over to a lender. But the digital home shopping sites are, they're a great tool. We're just going to see more and more of them, in all honesty. But back in 2023, the CFPB issued some guidance. Now, some guidance that they issued has been taken down, but this has not been taken down. And it deals with, digital home shopping, and digital mortgage shopping, comparison rate shopping, things along those particular lines. And it basically says, listen, you can do these particular things. You can collect an advertising fee or whatever type of fee you want to call it along those lines, but you can't take it. You can't take it to give someone a more prominent place to get that particular, pay more money and don't worry, we'll push you up front. You can't do that because Section 8 of RESPA still exists. And that's what they say over there. You can't do it to boost someone's ranking. You can't pay you more to boost their ranking and get up on the top of that list or something else along those particular lines. I don't think that's going to change, in all honesty. I don't think this administration wants to change that. I've certainly not heard anything about them wanting to change it. If Section 8 of RESPA were to go away, that would be a different story. But as long as we have an anti-kickback, which is an anti-referral fee prohibition, a prohibition against referral fees, digital home shopping and what you call steering or referrals, that law's not going to change. Okay. And it's important. And it goes to that issue. What does the consumer know? What does the consumer understand about what you're otherwise doing?
Love it. Got it. So before I got so many questions, man. I had a record amount of executives and leader when I told them that I was interviewing you, throw in questions. I always, I think I have like a list of 20 plus questions. We're not going to get to all of them. I do want to get into, comp. LO comp is back in the conversation, and I want to hear your thoughts on that. But before we do that, we've got the MBA advocacy event coming up, as you know, and we've got a lot of loan officers going this year. First Home IQ is telling loan officers that one, you should do this because it's the right thing to do, if you've made a good living in this industry. And it's also a great way to raise your personal brand, being the loan officer that's not just complaining about affordability, but you're taking the hill and making a case for what we could do to improve affordability. What's your thought on that? Why do you think it's important that loan officers specifically go lobby their members of Congress and senators on the National Advocacy Day?
I think so. Let me start off this way. I think it's extraordinarily important. And First Home IQ and the NBA is doing a great job of getting some loan officers out there. I actually think that 150,000 loan officers, and that's about what they are in the industry, should descend upon Washington, D.C. once a year and go visit their senators and their congresspeople. And you ask me why, okay? This is your business if you're a loan officer. The manner in which you are able to conduct your business, what you can do, what you can't do, okay? The effectiveness of what you can do, that is controlled by people in Congress. Okay. Both, well, people in Congress by legislators, both in Congress and in the Senate, as well as on the state level, quite frankly. I think they should lobby on a state level as well. The laws that are passed, and that are implemented by regulators, okay, are they tell you what you can do and what you can't do. You don't like RESPA? Well, if you never visited anyone and explained to them what it is that you think is wrong with RESPA, or think is unfair about RESPA, or why, RESPA that was enacted in 1974 isn't appropriate to today's market with the technology that we have, if you haven't explained it, you're going to live with it forever. That's just the reality, and that's true of every other law that's out there. So listen, it's your business, okay? I do this, okay? I go on the hill. I do things along these particular lines, okay? And it's not my business. I'm not a loan officer. So that's number one, okay? If you're a loan originator, you should do it. Number two, okay, and recognize you're in an incredibly highly regulated industry, okay? You've got a lot of laws. The CFPB had 19 consumer financial protection laws that it was responsible for. And believe me, it took advantage of every one of those laws. Okay. Where did that start? It started with the people that you would be going to visit on the Hill and lobby with. So it's important for them to understand who you are and you are a constituent, and for them to understand the nature of your business, what matters, what doesn't matter, okay, how things work out there. So they're not just legislating in a vacuum. So that's one thing. Another thing is it's really important for you. Really important for you. I mean, visibility is very important. If and I've done this many times in my life, I bought a number of different houses. I've lived in a number of different places. I've used loan officers. Okay. I've always done it on a retail basis. I've always, used a retail loan officer to do it. I want to know a little bit about you as well. I want to know your brand. I want to know who you are. I want to know, do you know something about this business that you're in? And what are you doing to further my cause, my issue? Because I'm the consumer on that end of the transaction, right? So you have consumers right now. We're in an election year, okay? And affordability is a major issue, not just as it pertains to home ownership, although it is a very major issue as it pertains to home ownership, but across the board. Affordability will probably decide the outcome of the midterm elections, okay? And should you be on the Hill? Should you be protecting your consumers? Should you be talking about affordability? I'm sure it's important to you, okay? Because affordability also impacts how many loans you're going to be able to make, right? It impacts the home ownership rate. And so, yes, I think it's really important that you go on the Hill for those reasons.
Love it. And so, guys, if you want to keep track of who's going, we've got a little live map that's getting updated. We're at 21 states being represented. By the way, this is First Home IQ. So through the nonprofit First Home IQ, these are the folks that we've influenced or helped sign up. We're at 52. Not all of them are loan officers, but we have some of the most successful loan officers in the country joining us. And yeah, they're joining us. I think Jeremy Forcier was the first one to sign up out of California. We've got a lot of great people, so check this out. If you are a mortgage executive, create awareness with your loan officers that this is something that they can do, they should do. Right now, California is leading with 13 folks joining. I don't care if we get to 20. I would like to get as many of the 50 states covered. And then another reason loan officers you should go, it's great social media content. We will have photographers, videographers in DC, and you could talk about what you're going to Hill to do locally before you get there, and then we'll have lots of content creators on the Hill. So cool. So let's get into LO comp. I mean, it's always been a topic, so it's not a new topic. But do you think there'll be any changes to LO comp anytime soon?
I do. I do think there are going to be changes to telecom. I can't necessarily tell you what all of those changes will be, or whether or not there'll be any restrictions on loan originator compensation at the end of the day. I mean, what the CFPB submitted to the OMB, was something that talked about rescinding the LO comp rule. That's what the CFPB submitted. But the loan originator compensation restrictions and prohibitions are set by Congress. You're going to need legislative change to rescind it in its entirety. So, and I don't think the industry wants it to be rescinded in its entirety, to tell you the truth. But will there be changes? Yes. It's interesting because what's happening at the CFPB right now is the CFPB seems to be out of, for the most part, out of the enforcement business. They're, you're not reading about things, they're not doing things along those particular lines. But this administration wants to get certain things done. They want some of these laws to be changed. And loan originator compensation is one of those laws. And fundamentally, it's not an administration that believes that one should regulate how you pay someone or what or what you can get paid, right? And so they're going to do something along those lines. They have attorneys that worked in enforcement and other divisions and things of that sort. They're trying to move them over because they want to write new regulations. And a new regulation can simply be a regulation that says we're taking these regulations down or something else along those lines. But to do that, they have to go through notice and comment rulemaking, right? So the CFPB is actually moving people over into the rule writing part of that to make changes to a lot of the rules that have given us heartburn and concern over the years. And I think they're going, and I know they're going to do something about loan originator comp. It could be that what they do is what the industry has been asking for and say, listen, if you have a down payment assistant loan or an HFA loan, you can get paid differently on that and help make that transaction happen. It could be that they could say loan officers can share, can help their consumers out, right? They can take less compensation so that they can get better rates in a particular example or something else along those lines and pay for that. It could be that they say that loan officers that make, a major mistake that causes a big cure can be held responsible for it. They can limit things along those particular lines, or they can go further and simply say, hey, you know what? We don't think that this should be regulated. Most industries aren't regulated as to how you can get paid. And they might try to wipe it out. It's going to be a long process though. I think what's going to happen is they're probably going to issue a an initial an initial rule, a preliminary rule that's not effective, but for notice and comment rulemaking, right? And so I think they'll probably be broad on that, which will probably take away a number of the restrictions, if not most of the restrictions that loan originated compensation has, right? But then they're going to read the notices, they're going to read the comments and things of that sort, and they're going to look to this industry. They are. I've heard them tell. They've told me that they're going to look to this industry to help determine, okay, what the ultimate rule should look like. So yeah, I think that's going to come down the road. In all honesty, but nothing happens overnight when it comes to rulemaking. I will tell you that.
Yeah, I think that's one thing we've all learned. Do you think there'll be any changes? I had a few different people ask me around just the comp on like a reverse mortgage is a lot more comp than on a standard loan. Do you think is that a topic
I
out there?
think it is a topic. It's been a topic in the industry for a very long time, and there are a variety of different reasons why that comp is so different. Some legitimate reasons and some not legitimate reasons. Sometimes that isn't necessarily in accordance with the act itself. But yeah, I mean, if anything, I think these guys want to simplify what's happening out there and probably want to look toward more consistency as well. Yep.
Consistency and simplification. Um, Bill Dallas had knew we were talking, and he had some questions with a renewed discussion around Basel III changes and just capital requirements and how that may impact the competitiveness between banks and IMBs. Any thoughts on that?
Well, I don't have a lot of thoughts on that because you don't know how it's ultimately going to come out, in all honesty. So I don't know what it's ultimately going to look like. I know there's a lot of discussion out there about how that's going to, how it's going to impact the competitiveness between, the two separate players themselves. And what if anything can be done about it, and whether or not banks, there are a lot of people out there. You go on LinkedIn, you see people saying banks shouldn't be in the mortgage banking business. I don't agree with that statement, by the way. I think banks belong in the mortgage banking business as well, and I think there are a number of different types of businesses and industries that belong in that business. So I don't think that's all been worked out, quite frankly. I will tell you, probably more importantly, and more than the impact of Basel III and the capitalization rules itself, is I don't see the large banks really wanting to jump into the mortgage banking business again. It's left, it's a very thin margin, this particular arena. It's a very, very thin margin. And there's a lot, and it's high risk. And the risk changes with elections as well. And so I think you're going to see regional banks, and they're going to continue on. And I don't think they're going to be hurt by what's going on with Basel III. So I think you're going to see regional banks. I think you're going to see credit unions. I think you're going to see, smaller community banks, and they're going to continue on in this business, and some will grow along those particular lines. But the large national banks, you know, they'll do what they have to do because you have to be in this business to a certain extent. You need to be a good bank, you've got to help your communities out. You have CRA obligations and things of that sort. But I don't see them I don't see them jumping in.
Good. Well, let's close out with my last question, and let's really target loan officers for how you answer this. Like, talk directly to the street and around loan officers. And there's a lot of things that they cannot control, but there's more things they can control. They can control how they quote loans. They can control how they market, what they put out there. But what is, in 2026, and let's not be long term about this. Let's just focus on this year. For Let's focus on local loan officers. What's your advice to them? If you were at a sales rally right now and you were talking to loan officers and giving them some advice on how they can play the compliance game, what are your closing thoughts to them?
So my thought is always make sure that consumer is in the forefront of your mind and the most important person to you in those transactions. That's what matters most. Do right by that consumer. Be fair with that consumer. Don't play a compliance game per se. Do what otherwise is right. Okay, I started off by saying when it comes to compliance, recognize we're talking about compliance with laws. I mean, there have been, times during our history when, the CFPB and others have expanded beyond what is lawful. And that's great. That's why you have people like me to take care of that, to sue them and to set aside what they're otherwise doing. But in terms of the basic laws that are out there, don't cheat. Don't cheat. You know, Work with integrity. I will tell you, I don't want to take credit for this because it was told to me by someone else, but I use it all the time. And I think it's absolutely right. I don't know if you know Jerry Baker, but Jerry
Jerry Baker well, and he reached out to me recently.
Well, he used to end his sales rallies and things of that sort, he told me, by saying, work with integrity and work as a team, right? Work hard, work with integrity, and work as a team. And I completely agree with that. I think that's the best advice you can give any loan officers.
Right on. Well, Mitch, grateful for you. Look forward to seeing you on the road. If people want to follow you, what are the best places to follow you? If someone wanted to uh, see if they
So
can get you to speak at their sales rally, where do they go?
I'm pretty active on LinkedIn, so you can find it on LinkedIn. You can go to my website, the firm's website, which is the wbkfirm.com. or you can just call me, quite frankly. Call me or email me.
All right, guys. So we will put links down below. Hope to see really hundreds of loan officers in Washington, D.C. Not only to create value for our industry, but to create value for yourself. You want to elevate your brand, be more well-known, be more well-respected. This event and this opportunity it's coming up. Well, Mitch, take care, my friend. I'll see you on the road, I'm sure. And
Hey,
everybody,
pleasure.
I hope you got, go ahead.
It's good seeing you.
All right, take care. Make sure you're subscribed to this channel if you haven't already, and make sure you follow Mitch. Take care, everybody.
I get spectacular memories when I go back to my old neighborhood in New York. That's a picture of my father, my mother, my sister, and me. And it's outside our home in Queens. I used to stand in front of that house and play stoop ball for hours and hours and hours and just throw balls at the house. There's nothing like coming home to a nice, warm home. Nothing like the security and comfort that brings you. I'm Mitch Kider. I am the managing partner of a law firm in Washington, D.C. that's known as Wiener Brodsky, Sidman & Kider, PC. I've represented this industry for almost 31 years now. You know, I love this industry. I love the people. I love the companies. They're wonderful, entrepreneurial, intelligent people. They house Americans. It's one of the most important segments, industries in this country. I'll tell you a story that tells you a little bit about me, and it tells you a little bit about people in the industry. My father is a great man. He was an immigrant to this country. He was a survivor of the Holocaust. He was born in 1914 in a little town in Russia. My mother was also a survivor of the Holocaust. She came from Czechoslovakia. It's a great American love story, actually. They met on the boardwalk in Coney Island. They fell in love, they dated, they got married in 1952. 6 months after I was born, my parents purchased a tract home built after World War II in Queens, New York, with an FHA-insured 4% interest rate loan. That's the house I grew up in. And my father, my mother, everyone, we loved that house. And every once in a while, we would go into Manhattan to visit some relatives or friends. And every time we got on the ramp to the Williamsburg Bridge, without fail, my father would look over to the left, and there was a big, beautiful, old bank building that was there. And as if he never told us this before, he would say to us, "That's the bank that gave me the loan to buy our house." My father was very, very proud of the fact that he owned a house, and he was proud of the bank and the individual that helped him get that particular house. That home started it all. It provides shelter, it provides hope, it provided opportunities for my family. It is generational changing. It is the classic American dream to come from nothing, to come with nothing in your pocket and be able to build a life. And it's a dream that for decades and decades has been made by the housing industry, especially the mortgage finance industry itself. And there's been a lot of bad press aimed at mortgage bankers in the last couple of years. But what people have to realize and recognize, for the most part, the people that work in this industry are working there because both their heads and their heart's in the right place. If you look at my little story of my parents who came here as refugees to this country, and you look at where it took me through home ownership itself, you should recognize that as mortgage bankers, you are doing wonderful things for society itself. Be passionate, work with integrity, do it right, and you are providing the ultimate public service.